Yeah.
All right.
Sweet.
All right. So we are live here on YouTube, and whether you're watching live or if you're going to watch later, but I got my buddy Sumeeth on, who is a lender here in Northern Virginia, where I live, where we talk about all things Northern Virginia. And Sumeeth, you know how it is right now. Everyone is going crazy. I just got back from Arizona to a real estate conference, and the whole thing was about the interest rates, like where are they going, what's going to happen. So, like, where are things like at the moment right now?
Sure. So, hey, thanks, number one, for having me on, man. I really appreciate it. And I love sharing advice on what's going on in this market. Very tricky to navigate. And I wish I could tell you exactly where rates are going because, man, if I could, I'd honestly be on a boat.
If you could tell me where rates were going, you'd be a rich man right now. I wouldn't even. Yeah, exactly.
You're
Yeah, and you're definitely like one of the better lender, one of the best lenders I've worked with from a long time. You know, because what's up, Market Brewer? But because you definitely like tell people how it is, whether they want to know it or not know it. But like right now, at this moment, where are the interest rates?
Sure. So if you're looking 30-year fixed conventional financing, this is actually fascinating to see, but you're looking right around between 6.75 and 7% without paying points to buy down rate. Average interest rates I'm seeing are being quoted with points at this point. So we're seeing, a lot of people charging 0.5%, which just increases your closing costs some to get their rate a little lower because there's some shell shock.
Right.
Customers are very shocked, surprised. I mean, first quarter, every once in a while, I kind of look back and see, some of the customers we've settled with and look at where we were with them. And it's pretty mind blowing to see, this much of a move in a very short window. Doesn't happen.
Yeah. At the event I was at, they actually had Goldman Sachs there. What they were actually telling me was, you talked about this a little bit more. They have to do this because the job market is too good, apparently, and like they need to slow down the economy by doing and inflation, so they're raising rates. So, in fact, they're kind of like screwing up the market a little bit by trying to make things better, I guess.
It's 100% true. And
right.
History, even though 42 years old, I was born in 1980. I do look back at previous years to kind of get data and knowledge. I don't think any market is the same, and I think your buddies there at Goldman Sachs probably share the same. That there's always some nuance and some difference in a market from market to market. But the last time we really saw inflation to this degree or level, you're talking about the 70s, and the last time the Fed's actions were to increase short-term rates. And if you watch, there's actually some really cool charts where you can kind of see the Fed funds rate going up in the mid 70s. And then you start getting to starting to move into the late 70s, tail end of that decade. And the Fed actually started cutting rates because there was a little bit of pain in the markets. Unemployment was starting to increase, et cetera. And so they kind of loosened the purse strings a little bit, decreased those short-term rates. And what happened? Then we got late 70s, early 80s, where rates got up to 12, 13, 14, 18%. I mean, really, really high stuff that would be difficult for our markets to take. The Fed's looking at this. That's their playbook. So they're seeing that, and they're saying, hey, we're not going to blink. We're getting a lot of pressure from Europe. We're getting a lot of pressure. Germany, I think, came out and said, hey, Fed, please stop increasing rates because there's some foreign currency pressures as well, which is actually making recessions in other countries impactful. It's starting to create some pain there, and they're asking us to stop. It sounds awful to say this, but I think the Fed has to continue. And yes, you're right; they have to kind of increase unemployment.
So like, let's say, so you live over by an Audi, right? So like, let's say I'm looking in Audi and I'm looking at 800,000, and I'm like, oh my God, the rate is, this is use it for number 7%. So I can buy that down with points. So what exactly, like how much would that cost and how much would that change?
Sure. So if we're talking about folks paying points, like this is pretty interesting. I don't think we can do share screen here, but really simply on an amortization, let's say your loan amount is 800,000 and you're looking at 7, right? So your principal and interest payment, $5,322. Once you throw in taxes and insurance, very realistically, you're probably looking every bit of $6,100 as a principal and interest payment, pretty sizable.
Right.
So we'll see a customer pay maybe a point. And the really interesting thing is, your normal old school adage, 1 point in buy down cost. So 1 percentage point, in this case, $8,000.
So $8,000. Okay.
Exactly. It would yield you 0.25% off in rate. So a quarter off in rate, it's helpful. I mean, you're talking about $140, $135, very beneficial. Today, because there's so much volatility. We're seeing a compression in the yield curve a bit, and now you're seeing a point might give you 3/8 to 0.5%. So you're almost getting $250 for it, that's sizable,
Gotcha.
it's real. You know,
So,
you're
but
talking-
so basically, yeah, $250 off. So you're talking what, like it's like $2,500 in a year. So as long as you're staying, here's what I tell everybody, and as you know, marry the house, not the mortgage, because most people refi anyways all the time. But so you're basically looking at a couple years to get your money back and more, you know, by buying down the rate, and hopefully by that time, 2 or 3 years from now, the rates are even cheaper than the higher they are right now. So
exactly. So that's one method or mechanism that we've been utilizing, right? That's 2.8 year break even, give or take. Whereas the normal adage is a 5.6 year break even, which is a long time. A lot of things are going to change in 5 years. 2.8 is not bad at all. Certainly a good strategy. We have some others though.
Right. So what other like programs can people do if they're like, man, I want to do an ARM, or is there something like that people can do?
Certainly. Interesting, because of the amount of volatility, ARM rates, conventional conforming, have really not been wildly attractive. I will say in the conforming space, for us, I know we clamored from the sales side to the top of the house at our company that we really needed a little bit more attractive ARMs, and we are seeing our conforming ARMs. So anything below 647,200 for this year. That loan amount will probably adjust.
So you could do an ARM under 647,000
with really good pricing, right? So 5 or 10% down payments. You know, you pay 1 point and you're getting like 6.25 or something like that, which is solid. It's better than what you just saw.
Yeah.
Certainly it helps, and that's like for a 10-year ARM. That's fixed for 10 years, man. It's not going to adjust.
Right.
10 years should be able to get you through any cycle. Real estate cycles. Right. I like the 7 personally, which is very good. That's great. And then ARMs on the jumbo side, which we're putting.
What's jumbo mean? That's like you're putting a lot of money down?
No, it means the purchase price is over in DC metro area 647, or I'm sorry, the loan amount is over 647.2.
All right, so jumbo's if you're borrowing over 647,000. Okay.
So that space is actually pretty attractive. Usually better for the 20% down folks, but if they're there, you know, we had a couple folks locking at 7-year ARMs for a best price jumbo product, 5.25, 5.5. I mean, like think about, you know, the difference if you do that same client. So let's say they were buying like a $1 million place and they're putting down 20%. So they got an $800,000 mortgage. Remember, we're talking $6,100 as a payment, right? Check this out. So you go literally down to 5,200. I mean, that's $1,000, right? That's really, really sizable. That's huge for a family.
Yeah. And a lot of people around here, one thing that people keep asking me, they're like, oh man, do you see a big foreclosure crisis? I saw a stat that only 1% of all home loans are on, people are behind on payment, which is like historically really low. The other thing is here, people in the DMV area have a ton of equity to tap in on their other properties. So they are able to put down the higher down payment and do things like the jumbo buy down, whatever you had mentioned, and things like that.
Absolutely. So those 2 things I think are huge. And I agree with you. There are areas of the country that are going to see, declines and already have, the news is a great resource to get information, but, if it bleeds, it reads, I think is an old adage. And, we're seeing it now. I'm seeing, my God, prices are coming down. Like, in San Francisco, where they went up 70%. Sure. Absolutely. And I think Iowa is one that they peg that's gone up really significantly. Coastal Florida, a lot of second home purchases in the last couple of years. A lot of Airbnb action happening where people are using these opportunities to buy houses as a business. Certainly, those areas, I would not be surprised to see a decline, but we're insulated here.
Yeah, I think we're still technically in a seller's market here. Who's not in a seller's market or new home builders? They're in a buyer's market now. And one thing I always tell people is around here, we just didn't really get the crazy new home construction like they had in Austin, Texas, or Orlando, Florida,
Sure.
And so that's really like affecting. And I feel like our prices have come down somewhat. They're not going like crazily down here, like in the DMV, but so like some areas, like you mentioned, like a Seattle or a Los Angeles, that's certainly like losing a lot of people. And then also the high price area. So like if you were, let's just say, I'm a buyer. I'm looking at 550,000 and I've got 10% down. Like, what is going to be my best avenue? Like what, at this moment, like what rate am I looking at? What would you do if you were me? And I said, you know what? I'm probably going to stay here 3 to 5 years.
Yep. So to me, the play is the temporary buy down, which, as funny as this has been around. Really, they used to call it the step mortgage back in the day in the 70s, which was in direct response to what we talked about before, where rates were 12, 14, 15%. People buying homes would step into their mortgage. So literally the first year they'd start out, let's say 2% below the 30-year fixed rate. So from a 12 to a 10. The second year they would go from 10% to 11%. And then the third year, they were at 12%. Now, the problem with that product back in the day is they actually didn't fund it with any capital. So literally you had a negative amortization, meaning the delta between your 12% rate payment and your 10% payment was being added to your balance each year or each month until you got to the full 30-year fixed rate. So people started out negative equity, not a good position to be in for most folks. So this variety that's been around, I mean, I can remember this from early mid 2000s. This temporary buy down we do differently. A lot of folks are kind of pushing this on socials and whatnot as well, but it's the same concept. There's just a capital component to it. So let's say you're 10% down. You want to buy this $800,000 house, right? You're going to mortgage $710,000. This is really cool and very fun for me to do. So let's say your rate
isn't really that fun, but I got you. Yeah, I got you.
I'm a little bit of that. So 30-year fixed rate, 6 7/8. You're not going to do the long-term buy down because you're 3 to 5 years in the house. So we do this temporary buy down. That means first year you're paying on 4,875. Second year you're paying on 5,875, and third year and beyond 6,875. But to me, this is where the magic happens. So your delta. You're at 4665 as a principal and interest payment. Your first year, you're actually going to be 3757. I mean, what is that? 850 bucks, let's say. So yet first year, you're saving 850 bucks as a payment. That's fabulous. It's not creating a negative equity position. Essentially, what we're doing is creating a reserve account that we hold as a lender, and each month the delta between what your payment is at this 4875 and what it was supposed to be, we're taking from that reserve account and we're shoving it over into your mortgage to make sure your payments are set up and you're paying the correct amount of principal. The second year, you're going to 5875. So 12 months surpasses, and now your payment has gone up. Now you're at like 4,200 bucks versus that initial 4660. So you're saving still 400 bucks, still very sizable.
So and if anybody I see people keep jumping on and on. If you guys have any questions, feel free to put it in the chat and I can throw it up there. And we can put the answer for you. Yeah. So there are options up there. One thing, I told you this story the other day is I bought my house in 2008, 2009 when like no one was buying. And my rate was like 6.5. And I remember everyone was like, dude, that sucks, Anyways, my house has doubled since then. Since refi, my rate now is like 3%. And I'm looking back at the time now. I'm like, man, if I had passed that up, I would have lost the double appreciation. So that's one of the other thing I like to tell people is the 2 to 3% rate, we were never going to be able to sustain that. If you locked in for a long period of time, God bless you. But looking at it now, I don't really think there's certainly plenty of things people can do. Plenty like what you're talking about, these different programs like that to kind of stop with the rising rates. And like me and you have seen from a couple of buyers we're working with, they've sat on the sidelines, and the rates have gone up 2 to 3% since they originally started looking.
Absolutely, you're 100% right. So going back to this thing, I love it. For these customers, because we are expecting in the next 18 months to have a refinance opportunity. You're not going to see 2s and 3s. So, people shouldn't wait around and think that's going to happen. It's the only time I've seen 2s in my career. And I imagine I will be long out of this business. We're dead. The next time 2s happen. So,
or something terrible happens and they like another pandemic, knock on wood, nothing with that. Yeah. Yeah, exactly, man. It's definitely for them to get back to that again. It would be a long time coming, I think.
Sure. And now here's the fabulous part about this temp buy down that I love. So with the long-term points, we talked about 2.8 year to 5 year break even, right? What happens if you get to refinance at month 12? So you've gotten 12 months in long-term buy down, right? You paid the point, you got the rate down 0.5%. You left that money on the table. It cost you $8,000, right? In that scenario. You saved money for a year and then you refinance. You don't get any of that money back. It's gone. If you do the temporary buy down, That first year was 10 grand of it. It costs about 15,600. So a lot of times I'll back off of the down payment and say, don't put down 10%, put down 7.5% and fund some of this money with your temporary buy down, so to speak.
Right.
Payment, right. Keep the same amount of cash in a pocket. After year one, you go to refinance, you still had $5,400 in the reserve account. Where does it go? It doesn't go into space, doesn't go into my bank account. I wish it did. It actually just brings down your loan balance as a principal write down. So you really don't have any waste of capital by leveraging yourself that way. And you're playing into, the expectations of what's going to happen in the market. I'm sure the Goldman guys said, hey, at some point, we're going to see that unemployment start to tick up a little bit. We'll see rates kind of correct. We'll see price stabilization from, the Fed's raising of interest rates and inflation kind of come down a little bit. Even if we're not at the 2% Fed target, we go from 8 to 4 or 8 to 6, that's going to give customers, people, that feeling, the American consumer, okay, I can breathe again. I don't have to worry about going to get milk that's now $5.
Right. Yeah. I'm not spending $10 for a gallon of milk or
exactly.
whatever. Yeah, definitely. Yeah. Or God forbid on me, $18 for 10 wings. I mean, my God.
Yeah. I'll tell you, brother, I'm definitely losing weight because I'm cutting back on what we're spending.
Yeah, exactly. Marker Burr says, what's up from the DMV? Man, dude, this is what's up from the DMV. I'm in Prince William. Sumeeth is in Loudoun. We pretty much, Sumeeth, where do you go? You pretty much go everywhere, right? I mean, I go anywhere in Northern Virginia, but you guys can go. You're at Motto Mortgage. You can go anywhere, right?
Yeah. So Movement, we can go anywhere.
Movement. What am I talking about?
You're good. Hey, no sweat, man. There's a lot of mortgage companies out there. But decreasing by the day, I'll tell you. But yeah, for sure, we cover my general territory is DC, Maryland, Virginia. We do some North Carolina, South Carolina, Florida, Georgia, license in PA, adding West Virginia. So we try to cover a really large territory. We don't have to drive 2 people, right? We can do a lot more of this, so it's helpful. And we've been really blessed that we've had a lot of support from customers, and we do a pretty decent job. So
the one thing I'll say about like you and Movement is a lot of consumers don't realize this. Like a lot of times they'll come to me with like a letter from another bank or something,
sure.
And I'll tell them, look, like a Rocket Mortgage or something. I'll tell them, look, yeah, you got it, but it's gonna be about 50-50 shot whether you close on time, and B, you actually get to talk to somebody, and they're not like in Michigan or somewhere else. So it's definitely good, like working with you and your team over there, because then you get to like actually hear from somebody. If it doesn't close on time, I only live 20 minutes away, so I'll probably be upset at you. Yeah. Right. Me and my Joker poster behind me will show up and be like, dude, what's going on? Not to say that you've done that to me before, but yeah, I mean that's definitely the good thing when you're using like someone like Movement or you like locally here, and the market. There's been plenty of people that I'm sure you've said like, dude, you don't want to buy a house there, that wherever that house is, so.
Yeah, for sure. I can certainly speak to community, just like local real estate agents. It's so important to work with local real estate agents. And I see, a lot of times people are like, man, I'm saving $500 by doing this or doing that. And it's like, have you guys talked about what you want and,
right,
what will yield, and had real conversations? Like, no, they just send me these listings and I just pick them. And then, I just have another person show them to me. And then another person writes a contract. And then another person does something else. It's like, man, so you don't have a relationship, but how does that first person tell the third person this is what they want? So don't write the contract this way, write it that way. And usually that type of setup leaves something, the human connection out. And I think it's really important to make sure that this hand tells the other hand what they want them to do, which is, why I also have a team just like you. And it's really important that we all stay very connected and communicate what the customer wants.
Yeah, definitely. Well, dude, I appreciate your time. So I'll put your information down in the description below. And so like we said, the rates are rising, but there are things you can do. And certainly you can get a good price on a house right now too at the same time.
Sure.
So yeah.
Absolutely. A great time to buy a house still. I know that may not be the thing that everybody would tell you, but to me, so many customers lose.
And here's what I've said it like 50 times probably around this call, and you'd say the same thing. If you're only going to stay there for 2 years, don't buy a house.
Absolutely.
If you're going to stay there for 7 years to 10 years, which I was just on a call the other day, they said the National Association of Realtors said the average person stays 10 years in their house. So if that's what you're planning on doing, it's going to be a place where you're going to make your family and your home. And yeah, definitely. And trust me, just like you, I was watching Sumeeth, 90% of it, I was like, I think I know what he's talking about. But the dude knows what he's talking about with his numbers. You know what I'm saying? So when he was like, buy down, blah, 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 but he'll tell you bottom line. He'll show you this is how much it's going to cost. This is your different scenarios. and then you run with it, you know. And two people real quick, not to kiss your butt 2 times, but I think I've had like 2 or 3 people this year that have been like, this is what I'm doing, this is who I'm using, then I've sent them to you, and then they've been like, holy crap, he beat my credit union or whatever. So
yeah, we've got some sharp products. We try to make sure we stay at the head of the curve, and you know, I'm not going to say we can serve everybody, but we certainly put our best foot forward, and we tell somebody honestly.
Yeah.
Too, you know,
Definitely.
This is something that you got a great deal on. Take it, run with it. If you have any problems, I'll leave your file open. And if you're having a hard time closing, you know, we'll take care of you. No problem.
Yeah, definitely. Cool, man. Well, I appreciate it. Thanks for jumping on this live for me. It was really helpful, bro.
Absolutely. You know, I love to share. Thank you.
All right. See you, buddy.
All right, brother.
Later.